Hello, this is Ernest Burley Jr., your cool insurance agent, back at you again with some more great information on insurance. Now, we're going to be talking about more than insurance. I'm going to expand our platform and talk about investing and financial planning and money management and things of that nature going forward in a lot of our different podcasts. So you guys already know, hey, I'm a licensed insurance agent with clients all over the country. Been in the insurance industry over 30 years, been in business over 25 years. But in addition to being a licensed insurance agent, I'm also a certified financial planner. I'm a chartered financial consultant. I'm an NFLPA registered player financial advisor. And I'm also an author of 2 books on money management. One is called Money Management Easy as 1, 2, 3. The other one, Money Management from Grade School to Grad School. So pick those up. I think they'll add some value to you, okay? To your life, to your financial situation. Okay, so now the purpose of this podcast is to educate you, to enlighten you, to empower you with clear, objective, unbiased information so you can make some great decisions for yourself and or for your family or your business or your church or whomever. Okay, so that's what this is all about. And we're going to talk about a financial product today, not insurance. We're going to talk about a financial product. So today's podcast is titled 401k plan versus a Roth IRA, which is better? That's a pretty common discussion out there. Some people are like, well, what's the difference and which is better? They're both great plans because they help you save for retirement. So let's just get that out of the way. Neither one of the plans is bad. So they're both very good plans. The Roth IRA and the 401k plan, great plans. There are several things you should consider if you're talking about or trying to choose one over the other, though. So let's take a look at some things that you should definitely consider. One thing is a matching feature. So if you're a 401k plan, and by 401k plan, I'm talking about all retirement plans at a job, basically tied to your employment. So that could be 401k, 403b, TSP. I don't care what it's called. We're talking about your retirement plan that's tied to your place of employment. Is that better for you? Roth IRA. That's what we're trying to target today. So now, first thing we want to take a look at is, does your plan at work have a matching feature to it? And by that, I mean, are they going to match part of your contributions or all of your contributions up to a certain amount? If you're going to get a match at your retirement plan at work, by all means, do that match first. Nothing beats free money. So say if you earn $100,000 per year and your plan has a 5% match in it, that means if you put away $5,000, your employer is going to put away another $5,000. So by the end of the year, you'll have $10,000 contributed to your 401k plan or 403b or TSP or whatever it is, as opposed to just your $5,000. You can't beat free money, so you always take the free money. Okay, that's not this. You don't have a matching component in a Roth IRA, right? Because IRA stands for individual retirement account. That's your own account that you contribute money to. So if you're going to get a match, always exercise and max the match. Okay, here are some differences between the two plans, a 401k plan versus a Roth IRA. And also you can have, there are a lot of 401k plans that have a Roth component to it. So here's a big tax difference. 401k contributions are pre-tax money that grow tax deferred. Okay, so that means it reduces your current taxable income. So you get a tax break. They call it an upfront tax break, basically. So if you make $100,000 a year, you put $10,000 into your 401k plan, you're taxed on $90,000, right? So it reduces your taxable income. So that's a tax break. So it's tax deferred money, growing tax deferred, okay? But eventually every nickel that you put into that 401k plan is going to get taxed. It's tax deferred growth, not tax-free growth. So you will end up paying taxes on that money eventually. But with the Roth IRA, the money is after tax money. So if you make $100,000 and you put $5,000 into a Roth IRA, you're going to still be taxed on $100,000. It's not like you have a deduction from your income on that. With a Roth IRA, is after tax money, but the benefit is, the great thing with the Roth IRA is the growth on it is tax-free as long as you hold it at least 5 years and until age 59 and a half. Not 5 years or 5 years and age 59 and a half. So if you start a plan at age 60, you have to wait till 65 before you pull out the gains from it tax-free, okay? So that's an and. That conjunction is and, not or. All right, so that's a big difference. The growth on your 401k money is tax deferred, which means you're going to get taxed on it eventually, the money you put in and the growth, versus the money that you put into the Roth IRA is after tax money. You've already paid taxes on the money you put in, but the growth on the money is tax free as long as you hold it 5 years and until age 59 and a half. That is a great product. The younger you are, the better because of compound interest on your money. Okay. Now, here's another difference between the two: contribution limits. The contribution limit currently on a 401k plan or TSP or 403b or what have you is $20,500. That's the most you can put away into that plan in any one particular tax year for this tax year. Okay. We're in 2022 now. I'm dating the podcast, but it is what it is. So that's the max for now. Now, if you're 50 or older, if you're at least 50 years old, you can put away an additional 6,500. Right? It's called a catch-up provision. So you can put away an additional 6,500. So that means you could put away $27,000 into that 401k plan. Right? Now, not so much with the Roth IRA. So the limit on the Roth IRA is $6,000. That's the most you can put away. Now, if you're 50 or older, you can put away $7,000. So there's a $1,000 additional catch-up for you in the Roth IRA. So a big difference in the amount you can put away into those plans, right? $27,000 max if you're 50 or older versus $7,000 max if you're 50 or older. If you're less than 50, $20,500 for the 401k versus $6,000 for the Roth IRA. So big difference in what you can contribute. RMDs. Now, RMD stands for required minimum distributions. Here's a big difference. With a 401k plan, at some point, you're going to have to take what's called required minimum distributions. At age 72, within 6 months after you turn age 72, you have to take what's called required minimum distributions. I speak with your accountant about this information. I'm not a tax person. But when you hit that 72 mark, it used to be 70 and a half, but it kind of got bumped up with the CARES Act. I think it was the CARES Act that bumped it up to 72. Now you can wait to 72, but you have to start taking money from those tax qualified plans at that age. So your 401k, your traditional IRA, any money that has not been taxed yet, basically pre-tax money, growing tax deferred, you have to start taking it at that point at age 72. It's called a required minimum distribution. So every year you got to start taking that money, pulling it and claiming it as income and paying taxes on that money. Versus with a Roth IRA, there are no RMDs. You don't ever have to take money out of that account. So that's another benefit for the Roth IRA. Income limitations. The Roth IRA has income limitations, but the 401k plan does not. You could be a multimillionaire and still contribute to your employer's 401k plan or 403b or TSP or what have you. No income limitations, but there are income limitations for the Roth IRA. Not going to get into details there, but basically, if you're single, if you're at 129 or less, you can contribute the maximum amount. But once you start getting past 129, there's a phase out to $144,000. Once you get to 144, if you're single, you can't contribute. If your adjustable gross income is 144 or more, you can't contribute in that particular tax year. If you're married filing jointly, it's 204. So 204 or less, you can contribute the full amount, each spouse. But once you get over 204, the phase out goes from 204 to 214. And once you get to 214, neither one of you can contribute to a Roth IRA in that particular tax year if your adjusted gross income is at 214 or higher. Okay. So, this information, you can find it on irs.gov. So www.irs.gov has all of these restrictions and contribution limits and things of that nature. Okay. Now, loans. Here's another difference between a 401k plan and an IRA. 401k plans normally have some type of loan feature in them. IRAs don't have a loan feature. So that's something to consider too. I've had clients who've said that, hey, I needed to take a loan. So that's why I wanted to wait to roll over my 401k or TSP or whatever, because an IRA doesn't have loan features. So you wouldn't be able to take a loan from your IRA. Now, in my opinion, my humble opinion, I say if you want to say, okay, which one is better? Oh, Ernest, you gave me all this information. Which one should I go with? Which one is the best? Well, it depends. It totally depends. So if you have a matching 401k plan, I would highly recommend taking that free money, maxing the match. If you have more money to put away than they're matching you, then I would say put the balance into your Roth IRA, but there's a cap on the amount you can put into your Roth IRA, right? So once you reach that cap, if you have more than that, then you put the balance into the 401k plan, right? I know that sounds like you kind of bounced around. So let me give you an illustration. Say if you had $1,000 per month to put away towards retirement, and you're wanting to put money away for your retirement, I would say, okay, put away that match money first. So let's say, for instance, for example, you make $100,000 a year and you have a 5% match. Okay, so that's $5,000 of a match for you. That's the first thing you want to do. Make sure you're putting away $5,000 into that 401k plan. So that's about $417 per month, right? If you divide 5,000 by 12, that's $417 per month. So I would say $417 goes directly into that plan first. Nothing else. Open up a Roth IRA and put the balance in there up to the max. So if you're less than 50, the most you can put away is $6,000 per year. That's $500 per month. So I would say $500 per month goes there. So 500 plus 417, that's 917. That leaves you $83 that you can still put towards your retirement. You can't put it into the Roth IRA, right? Because that's your cap. Well, I would put that $83 into the 401k plan. So that would be 500 going into your 401k, 500 going into your Roth IRA. Now, if you're 50 or older, I would say that $83, I would put that into my Roth IRA because 7,000 divided by 12 just happens to be like 583. 583. So I will put that amount into my Roth IRA, 583, and keep the 417 and the 401k plan, and that's it. Now, if you have more money to put away than that, then I would put the additional money into the 401k plan because tax deferred is better than having the money going into some taxable account for sure. So that's just my humble opinion on how you would kind of facilitate that and coordinate that to take advantage of these tax qualified plans, okay? And of course, you want to make sure the portfolios are diversified accordingly to give you some good growth potential, okay? And that's it. That's it for today's podcast. Since that we talked about investing or financial products, I do have to give you a disclosure, so please listen in on this. Burley Insurance and Financial Services, that's my firm. Burley Insurance and Financial Services, Inc., that's the name of my company. I'm located at 13621 Annapolis Road in Bowie, Maryland. Zip code is 20720. Further disclosures read as follows. Securities and investment advisory services offered through Next Financial Group, Inc., member FINRA and SIPC. Burley Insurance and Financial Services, Inc. is not an affiliate of Next Financial Group, Inc. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Past performance does not guarantee future performance. All the views expressed are those of Ernest Burley Jr., moi, and Burley Insurance and Financial Services, Inc., and not those of Next Financial Group, Inc. Next Financial Group, Inc. does not provide tax advice. Okay, so that's my disclosure for our topic today, which talked about 401k plans, Roth IRAs, financial products, and things of that nature. So that's it for today's podcast. The recap is both plans are great plans. So a 401k plan is a great plan. Roth IRA is a great plan, but I just went over the differences, some of the major differences between the two, so you can decide which way you should probably go. A major takeaway, here are the takeaways. Well, the main takeaway is to do what makes sense for you. Definitely do the match money. So the match is a no-brainer. You do the match money, right? Now, and then after that, you decide, okay, do I need a tax break? Okay, so you do the tax deferred plan, which is a 401k plan. Like some people don't have any tax deduction. So they're like, I need the tax break. I need something to reduce my taxable income. So they may say, hey, I'm putting $20,000 into my 401k plan. That reduces my taxable income. Okay, I get it. Okay, if that's what you need, I get it. Or are you more partial to having tax-free growth to say, okay, well, I'll take the tax hit up front, but I know when I retire, all this money, if I hold it 5 years and until age 59 and a half, all the money I have in this Roth IRA is mine for the taking. When I pull money out of it, I don't have to worry about being taxed on any of it because the amount I put in was already taxed and the growth on it is tax-free. Which one is more important to you, tax deferred growth or tax-free growth? Just have to make that decision yourself, okay? That's it. Thank you guys for listening. I appreciate y'all listening every week. I ask that you share this podcast with others and ask them to do the same, and so on and so on and so on. So these podcasts can become viral. If you want to connect with me, I'm easy to find. Just email me at ernest@ernestburleyjr.com. So it's my first name at my full name.com. Ernest, ERNEST, at ernestburleyjr.com. That's ERNEST BURLEYJR .com. Ernest at ernestburleyjr.com. All my podcasts are on YouTube, so please go onto YouTube and check them out. Some of them are like podcasts like this. Some of them are short snippets about different topics. I talk about everything from insurance to real estate to employers to entrepreneurs to business owners to just a whole wide array of different topics that can help you out in the financial planning and money management and insurance arena. Okay. That's it for today. That's it for our podcast. Hopefully you got some good information from there. And until next time, I'm signing off. This is your cool insurance agent and your certified financial planner and your chartered financial consultant and your author of 2 books on money management and your NFLPA registered player financial advisor, Ernest Burley, signing off. Until next time, y'all take care. Be safe out there. Okay.